The SOX, which is the index that tracks the entire semiconductor group, well, it recently fell into a bear market, and it's down more than 20% from its high just a month ago. And at one point on Friday, it was down almost 6%. And that's exactly why I wanted to make this video right now. Because here's what these sell-offs do. They don't just punish the overvalued names, they actually drag down the strong ones with them. And for me, that's where the real opportunity hides. Because look at what these stocks have done. If you were lucky enough to buy some of the biggest names in AI over the past few years, you already know the feeling. A $10,000 investment in Micron just 1 year ago, and you'd be sitting at around $85,000 right now. And that's even after last week's drop. But those names have climbed so high that a lot of investors are now afraid that it's a bad time to get in. And this week's pullback only makes that fear a little bit louder. So I want to shift gears and I want to talk about strong companies that are either earlier in their growth or where their future revenue is already booked and the growth is still building. And when you look on paper, they still look undervalued. But hey, before we jump in, quick reminder that I'm not a financial advisor and I do this all for educational purposes. But if you're getting value from the research on my channel, then please press the like button so my channel can continue to grow. And if you want deeper research and my actual trades that I'm making in real time along with my portfolio, then I share all of that with my community over on Patreon. Now with that out of the way, let's go ahead and get into those stocks. The first company is Sterling Infrastructure, the contractor that most every hyperscaler is calling before a data center can even begin breaking ground, where they move millions of cubic yards of earth across a 200 to 300 acre site, grading it dead flat and burying the power and the water underneath it. Their entire edge is that Sterling self-performs the whole scope of work under one roof, so the job never stalls waiting on the next crew. And for a hyperscaler, every day that a data center sits unfinished costs far more than a higher bid ever would. Now, this used to be a low-margin road builder that was losing money. Today, the data center site work is about 70% of revenue and grew 174% year over year just last quarter. Operating margin climbed under 8% to almost 17%, and earnings per share are up more than 110% in just 2 years, with management guiding for them to nearly double again this year. And the backlog for them is the big tell. They have $5.15 billion of work already booked against just $2.49 billion in revenue last year. So more than 2 full years is locked in before the year even starts. And at a peg near a 0.88, you're simply not overpaying for that kind of growth. Next up is Oracle, and I know I'm going to probably get a little bit of flack for this one, but they're the company that rents out the raw computing power that AI labs like OpenAI use to train their models. Through its cloud arm, OCI, Oracle builds the data centers and leases the GPU capacity to the companies that need enormous compute, but they don't want to rent it from a direct competitor like Amazon or Google. Its edge is really just being neutral, and it engineered its cloud to run AI training faster and cheaper than the older, general-purpose clouds can. And Oracle's story this past year is pretty wild, because a year ago, it was one of the hottest stocks on the market, more than doubling to around $279 a share by last September. But since then, it's been cut in half, and a drop that size usually means that something's broken. But the reality is the business is thriving, with revenue up 17% to $67 billion. But what really spooked investors was their spending. So to build out those data centers this demand requires, Oracle's capital expenditures exploded more than 1,100% in just 4 years to almost $56 billion. And that pushed free cash flow from a positive $12 billion to nearly $24 billion in the red, a $36 billion swing. But here's the thing, that build-out is already spoken for. Oracle is spending against a backlog of signed contracts that grew 363% in a single year to $638 billion. That's nearly 10 times everything that it sold last year alone. And like I said, that revenue is booked, and it's set to carry Oracle from $67 billion in sales today to around $140 billion within just 3 years. At that pace, as free cash flow flips back to positive over the next 2 years, the stock has room to climb quite a bit. Like I said, I know I'm going to get a little bit of flack about this company, but the reality is it is undervalued and I see a lot of potential. Now, there's one small cap that you might want to put on your research list, which happens to be today's sponsor, BioStem Technologies, which is a regenerative medicine company that uses proprietary perinatal tissue allografts to heal chronic, non-healing wounds, the kind that come from diabetes and surgeries. And that matters because the global wound care market is projected to reach $27 billion by 2027. And the reason that BioStem is now on our radar is because the company just filed a Form 10 registration statement with the SEC, which is a required step toward uplisting from the OTC market to the NASDAQ, which would expand access to capital and put the stock in front of a much larger pool of investors. Their BioRetain processing method creates placental allografts built to improve wound closure for diabetic foot ulcers. In a randomized controlled trial published in the peer-reviewed International Journal of Tissue Repair, wounds treated with BioRetain had a 53% probability of healing, compared to 31% for the standard of care. The company backs it with accreditation from the American Association of Tissue Banks and a portfolio of issued and pending patents protecting its amniotic tissue technology. BioStem is putting real clinical data behind its products, while it works towards a NASDAQ uplisting, and that's the type of momentum worth digging into. As always, do your own diligence and check out the link down in the description to learn more about BioStem. Now we'll move on to Modyne, which builds the entire liquid cooling system that keeps a rack of AI chips from really just cooking itself. Now, a normal server rack used to draw between 5 and 15 kilowatts. It was cool enough for air, but an AI rack now pulls 50 to over 130, forcing the entire industry onto liquid cooling, and it's going to be piped straight to the chip. Now, under its Airedale brand, Modyne sells the whole stack: the chillers, the coolant distribution units, and the controls, not just one piece of it. That full stack position is why hyperscalers are reserving capacity years out. And one customer committed to more than $4 billion of cooling gear from 2027 through 2029. With about $165 million paid up front. Now, a few years ago, data centers were just a rounding error here, but last year the business grew 73% to about a third of the whole company. Management is targeting close to $2 billion by 2028, and adjusted earnings grew 24%, while the company spins off its legacy auto parts arm to become a pure play. The stock does trade a touch rich against its own fair value, but at a peg near 0.6, you are paying a fair price for real growth. Now we're going to move on to Broadcom, and they're the company that designs the custom AI chips that the giant hyperscalers are using to try to escape from Nvidia's pull, and they're also building the network silicon that wires them all together. In this case, when Google, Meta, OpenAI, or Anthropic wants its own accelerator, instead of renting them from Nvidia, it designs that chip with Broadcom. So in this case, Broadcom gets paid no matter which model is going to win. Its AI revenue is on track to nearly triple in a single year, and it's already sitting on about $73 billion in booked AI orders. And that's more than the entire company sold last year across every business combined. All of it is throwing off almost $27 billion in free cash flow. So that's about 42 cents of every revenue dollar. So when you look at it on paper, it looks expensive at 60 times trailing earnings, but that's an illusion from VMware amortization burying those profits, because on forward earnings, it's closer to about 24 times. Now I get it, I did cover Broadcom literally about a week ago, and I'm bringing it right back because it sits at a peg near 0.48, so it's still cheap relative to its growth. And now we're going to move on to Lumentum, which owns the EML laser chip, the tiny light source buried inside every high-end AI optical transceiver that shuttles data between all the racks. So every 800 gig and 1.6 terabit module, well, it's going to need several of these. And Lumentum makes 50 to 60% of them, and it is the only supplier shipping the 200 gig per lane version at volume that the newest links depend on. That is a genuine choke point, and it's why Nvidia designated Lumentum's optics for the next generation Rubin platform. Look, for years this was a struggling telecom name bleeding money, running an operating margin as low as negative 25%. Then the AI orders began to hit. Revenue climbed 90% year over year last quarter, and the operating margin swung to positive 22%, the point where a company crossing into real earnings builds its fastest momentum. The loudest signal really came from Nvidia, which paid $2 billion as an investment into the company. And I try to bring that up every time because honestly, if Nvidia is willing to invest in them, there's going to be some growth potential. But I do want to point out that on top of the lasers, Lumentum landed a multi-billion-dollar optical switching deal that's already carrying a backlog north of $400 million. And honestly, that demand is only just starting to hit their numbers. Now we're going to move on to Credo Technology, which builds active electrical cables, a copper cable with a signal processing chip built right into the connector. Our reality is that plain copper is going to die past a meter or two at these speeds, and optics is expensive and power hungry. So Credo's cables retransmit the signal to run several meters farther, cheaper and with far less power. So what matters inside an AI cluster is reliability, because one flaky connection can stall a training run worth over $100 million. And Credo created this category, and they own roughly 88% of it. And that has made it the fastest growing name on the entire list. Revenue more than tripled last year, up 206%. And at a 68% gross margin, which is software territory for a cable maker. And operating margin swung from negative 19% in the red to a 33% profit. And that's what I'm really looking for. When we see that flip from startup mode to real profitability, and that's where the momentum really begins to build. And for all that growth, the stock is still relatively cheap on a PEG basis, which is well under 1. So you're paying a lot less than $1 for every dollar of growth that's still ahead of it. Now, the next one up is SanDisk, and that's probably going to be a little controversial in this group, so please just hear me out. And they're known for NAND flash, and that's the chips that store data permanently, the same memory in your phone and in the drives packed into the AI data center. Now, to make the point, the memory that's bolted next to an AI chip today is HBM, or high bandwidth memory. It's blazing fast, but it's expensive and it's cramped, holding only about 50 gigabytes in a stack. SanDisk pioneered an alternative called high bandwidth flash, or HBF, that essentially matches that speed but holds 8 to 16 times more, on the order of 512 gigabytes at a similar cost, which could roughly double the size of SanDisk's market. And it is co-writing the industry standard with SK Hynix, while a giant like Samsung is still at the early concept stage. So this is a company with only about 13% of the NAND market, holding the pen on technology that could reset the entire business. As a reminder, SanDisk had spun out of Western Digital last year near $38 a share, and revenue just exploded 251% in a single quarter. It used that windfall to wipe out its entire debt and authorize a $6 billion buyback. As of today, it's trading under 10 times next year's earnings. And while memory is cyclical, the multi-year supply deals that are already signed and HBF still ahead, they give real reasons that this run is gonna outlast all the ones before it. And now we're gonna move on to Tower Semiconductor, which, if you're familiar, they do not design chips. They manufacture them for the companies that do. Tower is a specialty analog foundry, and its most important platform for AI is silicon photonics, the chips that turn electrical signals into light inside those optical connections. It's only one of about 3 companies making photonics at real scale, and the open neutral one that the whole industry can share as well, which is why names like Marvell and Nvidia run their photonic chips through Tower. So its silicon photonics revenue more than doubled in a year, and operating margin climbed from about 9% to nearly 16%. Now, photonics is still only about 15% of Tower's revenue, so this is a forward bet on top of a very broad foundry base. And that premium multiple only works if the AI leg keeps compounding. But with earnings growing better than 50% a year, its forward pay ratio is near 0.91, which keeps it very reasonable. And their customers are pretty much just voting with cash against roughly $1.57 billion in annual revenue. And Tower has already booked $1.3 billion of silicon photonics orders for 2027, and they've taken $290 million up front just to reserve their capacity. And now we're going to follow that up with Cohu, which makes the machines that test semiconductor chips after they come off the line, holding each chip at a precise temperature, pressing it onto the tester and sorting good from bad before it ever ships. Now, the parts that matter for AI are its Eclipse thermal handler, which tests GPUs while controlling the intense heat that they throw off, and its Neon system, which inspects the stacked memory and AI chips, with that inspection revenue guided to grow about 80% this year alone. Now, to be very clear, AI is only about 2% of its sales today, so this is really a deeply cyclical test business coming off of the bottom. At its last peak, Kohu had earned $3.45 a share, and it is now only beginning to climb back out of that loss, with orders already up 57%. And behind all of that is a pipeline of AI test work worth around $750 million. It's not even booked yet, but larger than its entire revenue last year alone. And with 60% of sales recurring consumables all underneath all of that. So you're not going to be paying up for peak earnings here. You're buying for a business that's still priced for the downturn it is only now beginning to climb out of, right as the recovery and the AI demand start to arrive all together. And then on to our next company, which is Enodata, which produces the expert labeled data that AI models are trained and tested on. Like, this is essentially the textbook and the exam that a frontier model is going to learn from. It already does this for 5 out of the 7 largest tech companies. And honestly, I think its biggest wave is still ahead of it. And this is where I'm speculating a little bit and trying to see the trends. Because the way I see it, as every large company starts building its own AI agents, they're going to need the same data, plus a way to continuously test whether those agents are correct or not, which turns lumpy project work into recurring revenue and its market from a few labs into potentially the whole economy, with the agentic slice alone projected to grow more than 5 times by 2030. Now, a couple of years ago, there were some doubters about what they do, so some short sellers actually filed some fraud accusation against them, and those accusations completely collapsed, where the DOJ and SEC, they both closed it with no action. At the same time, their revenue had grown 48%. And to give a little more context, the revenue has nearly tripled in 2 years to $252 million. And the company made a complete swing from a loss to up to $32 million in profit. And yet the market is still treating it like an afterthought, even though its growth is accelerating. So there you have it. Those are the undervalued names that I'm watching right now. It's the companies that are actually building the AI boom, and they're still growing extremely fast, and they're still priced like the market hasn't quite caught up to them quite yet. Now, if you're interested in what I'm looking at for specific entry points on these stocks, I am going to be looking to share that on my Patreon. So if you're interested in the community, I'm going to do a little extra research to try to share that. In either case, I hope you got some great value in today's video, and as always, thanks for watching.